Hi, folks. Greetings. We are now live. That's what it's telling me on the prompter, by the way. We're going to talk about the current market and what we might be able to expect. Of course, our crystal balls are somewhat broken.
So we have someone else's.
But we have an expert in the field.
That's right. That's right.
And we'll talk about that right after this. Hi, everyone. Thank you so much for joining us on the
Real Estate Investor Show. Hard money for real estate investors.
Thank you, Jonathan, for the save.
No problem.
I still have this lingering cough. I hate it. Anyway, we are Carolina Capital Management. We are private lenders in the Southeast for real estate professionals. If you are interested in us looking at one of your projects, then go to carolinahardmoney.com. Click on the Apply Now tab. If you're a passive investor looking for passive returns, click on the Accredited Investor tab. Don't forget to like, share, subscribe, hit the bell, and don't forget about Wednesdays with Wendy. So as you may know, Wendy devotes 30 minutes per person on Wednesdays to talk about anything real estate related, and her schedule is usually booked up a couple of months in advance, right?
Yep.
So
absolutely.
There's a link right there. There's also a link in the chat, which is on the right hand side or underneath your screen, depending on the platform that you are viewing us from.
Well, I know. Just to jump in there, we have Brett Sims from Renovo Financial with us today, and he is the head of growth, and he very, very intelligent man who has been watching the market for quite some time, has a lot of insight. We're going to bring him on in a little bit. Before we do that, I think you had some news that you wanted to share.
We all have news, right? News?
The news? Well,
yes. As we made fun of last week, our breaking news, our intro is so long that the breaking news is no longer breaking.
Yeah.
So they had the CPI numbers for October.
Better than they thought, huh?
Yeah. So that when I left for work this morning, the futures in the stock market were up like 800 points because, they're assuming the Fed's going to pause a little bit on the rate hikes. I don't believe so. Frankly, I'm seeing in my brain, my prognostication.
Prognostication. There you go. Yeah.
Man, I'm having a tough time.
It's all right. That's why I'm here.
I'm thinking that the Fed rate is going to be what the inflation rate is before they stop.
I think that they're going to exceed it.
Could be.
Yeah. Okay.
But that said, the numbers are a little bit better. Used cars went down a little bit, which is nice, but the energy, food, all that still keeps going up.
Yep.
Produce has gotten the inflation rate on produce has gone down, but the inflation rate on staples, cereals, pastas, that kind of stuff, that's going up.
Yeah.
So if you look at it, more people with more money buy more fresh produce because it costs more typically.
Yeah.
And the people with less money are getting the ramen noodles and that kind of stuff.
Yep.
And who's getting hit worse? It's the people with less money because those things are going up.
Yeah, they have the highest markup margins. Yeah.
It's a shame.
And, you talk about the jobs, they were higher than they thought, which I think the bright point was, I think it was it hospitality and retail were some of the bright points in the jobs report.
Yeah. Well, there's a lot of pent-up demand since the pandemic, so people are still traveling and stuff.
All right. Well, cool. Well,
also, real quick, Redfin shut down their home flipping business. Those companies like Zillow and Open Door. They were not really home flippers. They just got into it because there were high margins.
Yeah.
And they didn't really, they're losing money. By the way, Redfin, that home flipping business of Redfin's was 43% of their revenue last month.
Wow.
That's going to be a big hit. They're shutting it down.
Yeah. Wow.
And then lastly, San Francisco is having issues with their vacancy rates in commercial property and
they're just too low, aren't they?
Well, they have about a 20% vacancy rate.
Yeah.
They have 65% of their business tenants are, high tech.
Yeah.
And they have the most liberal work from home policies.
Mm-hmm.
Not to mention the people that do come to work probably don't like stepping over folks on their way into the office.
Might be that.
And so we're looking at probably around a 40% maybe drop in commercial values.
Wow.
I'm sure they were already way up there too high anyway. They were overblown. What do you have?
Nothing. You've covered it all. I don't want to get too. Oh no, it's good. I don't want to get too deep to it because I want to bring Brett on and give him as much time as possible because I really want to hear his expertise and what he has to say. Will you go ahead and bring Brett on?
Brett, thanks so much for joining us.
Thanks for having me. It's good to listen to you guys and run through some high-level numbers that came out today. Interesting morning.
Yeah, it really is. It really is. Well, like we said, Brett is with Renovo Financial. He's the head of growth. You've been there for some time now, haven't you?
I joined right at the end of 2019. So
right in 2019.
Coming up on 3 years. We've experienced a lot of growth. When we started, when I joined, it was a Chicago-based lender. We've since expanded into 14 new markets over the last 2 years and dramatically increased our originations and product suite from historically fix and flip and bridge loans now through the full gamut of fix and flip and the DSCR product.
And the DSCR is really, where we want to focus because that has seen the most disruption and change in the last 9 months. So kind of, tell us what are you seeing in the market, kind of give us, your genesis and perhaps we'll ask for the exodus as well.
Sure. I'm with you guys, not as bearish, but I think today's market movements are perhaps a little bit of noise. I believe that the Fed has signaled that their terminal rate, so where they think Fed funds is going to go, is about 5%. So today we're sitting at 4%. That's another full percentage point increase to Fed funds, which starting out at the earlier part of this year was at 0%. Right? And that's the number that they think is going to be needed to bring inflation back to their 2% target. So why do I start there? Is largely because if you think about the DSCR product, it's very much a market-based rate. And the Fed funds rate is the benchmark for the U.S. debt capital markets. Right. Yeah. And if you think about that as the risk-free rate, everything that has a little bit more risk to it has a spread over that benchmark. Right? So if we go into kind of DSCR and what we've seen, I think earlier in the year when Fed funds were around 0, we were seeing DSCRs in the 4s and conventional mortgages in the 2s. Right. And I think about typically the spread between a conventional mortgage that's government backed, usually packaged up by one of the agencies, to DSCR tends to be 1.5 to 2 points. So if conventional mortgages are at 3%, DSCR product at 4.5, 5 makes sense.
Yeah.
Fast forward to where we are today, and you're seeing, conventional mortgages at 7 and DSCR at 8.5. Right, and that feels about right with where we are today based on the market. So what's driving that? It's not just Fed. It's not just rate increases, I should say. It's also the fact that they're doing quantitative tightening. And what does that mean? The Fed had been, in order to inject liquidity into the economy and keep us out of the COVID recession/depression worries, they were buying mortgage-backed bonds. So they were injecting lots of cash and keeping rates artificially low. They've since stopped that. Now, they're not selling them, but they're not reinvesting. So as those mortgage-backed bonds mature, they're pulling money out of the market. And so you've lost a large buyer of mortgage-backed securities. And so that's just incremental pressure on mortgage rates going up.
Yeah.
And so with those pressures, that is what I think you're seeing on the DSCR side, right? You're seeing the exact same pressure based off the same benchmarks at a credit spread that's wider of 1.5 to 2 points more than where you'd see conventional mortgage rates.
Yeah. And, one of the biggest pains that, that real estate investors that I've noticed are seeing right now is, a lot of these people, they do, fixed to rent. So they go in and they buy it, and fix it up to stabilize it and put a tenant in there. Well, that process sometimes can take up to a year to achieve that. So they've bought in January, underwriting at those rates and those prices, and fast forward to now, they're trying to exit into a DSCR program based off of a cash flow that doesn't really support the new interest rate. That's 450 basis points above where they were underwriting. So we're seeing a lot of equity and a lot of investors having to keep a lot of equity in their deals. Are you all seeing the same thing?
Absolutely. I mean, like the DSCR, the biggest driver there is your interest rate, right? Your debt service coverage ratio. So as interest rates move up 400 points, it's going to push down on that coverage ratio. And in order to actually get deals done in the broader market, you've got to have whatever that number is, 1.0, 1.2. And so the only lever that you have if rates are going up is to reduce the leverage. So definitely I'm seeing lower LTVs. I'm seeing people that, are having maybe to bring money to close, whereas that wasn't the case when it was originally underwritten, or that investment was kind of penciled out. And so, some of the things that we've done to try to ease some of that is come up with potentially shorter prepay periods. So maybe there's a 1 year or 3 year prepay penalty. So that, gives you some time that, like, I've got to take this off. I know I'm going to have to, lower leverage. It's not exactly where I thought it would pencil out. But, if I give it a year or two, things are likely going to change, right? That's, again, my cloudy crystal ball says, I think we're in this elevated environment for another 12, 18 months. That's at least what the market's predicting if you look ahead at kind of yield curves. And so that's one tool we have, but you're right, there's not a lot of tools out there. So definitely we are seeing the same thing in our business and with people I talk to pretty regularly across the private lending space.
From an investor's perspective, if you paid a little bit too much for the house, let's say, based on the numbers not penciling out, it's not a loss. If you have the wherewithal, and by the way, when you do these deals, if everything has to pencil out perfectly, and for you to make money on this thing, you shouldn't be buying the deal in the first place. So my point there is homes will appreciate over time. Rents will continue to go up over time. Eventually you will catch up with that. If you have to bring more money to the table, it just means you can't leverage as much. It doesn't mean the deal is any better or worse, because over time, your rents are going to go up. Your payments are going to stay the same unless you're in an adjustable. And at some point, when rates do come down, you can always refinance. Not to mention you get the tax breaks that the government gives you on these. I'm sorry, I'm preaching to the choir here.
Yeah, no, I
want people to panic. That's all.
Yeah, I don't think it's time to panic. I think that certain markets in terms of home price appreciation, if you bought something 6 months ago, you may have paid at a premium where they are today. But it'll likely come back and rents will likely catch up. And I think you're absolutely right. If you're thinking about a deal as there's some room in there, there's some contingency, it's the right location, that the rents are there, you've got a good product, you just might have to wait a couple of years in order to get kind of the leverage you originally expected.
Yeah, in most cases, people that are buying rental properties they're doing this for the long haul anyway. It's a long game. You're not going to get your payoff right away. It's nice when money was free, but it's not happening anymore.
There's a lot of people who got spoiled. Go in, buy a house, put a tenant in there, and refi it 4 months later, and it's worth 120% of what you paid for. Like people got spoiled, and that's not typical, and that's not a normal course of market. And and then now we're seeing, okay, call it a correction, we can call it whatever we want. It is taking out a lot of the players who probably shouldn't have been in the game anyway.
Hey, Brett, we're talking about rates in the 8s, 8.5, approaching 9. That's a pretty good return on your money in a fairly safe asset class, right? So typically the people that are running the safety are going into the bond market, and they're getting 3, 4, and they have to wait 2 to 5 to 10 years, depending on what it is they're buying. Do you see a lot more private capital coming into the DSCR business versus how it's been working now?
Because we've seen a lot of capital exit the DSCR business.
Yeah, I think that's a really great question. I think what you're seeing is probably a net outflow. However, there's new entrants coming in, right? So you think about where do these DSCR products end up? They end up in basically the same places that the regular QM mortgages and non-QM mortgages go, right? So they end up in securitizations that become bonds that are then sold to pension funds and other large investors, insurance companies. They end up with asset management firms that are placing them in specially managed accounts for the same large institutional investors. And that's the liquidity behind the market. And that's why, frankly, I think we as the U.S. have the best mortgage market in the world, is because we have this liquidity and we figured out how to tap into these. So what I think you're seeing some players exit, notably a huge one, the Federal Reserve, which is putting pressure. But you're also seeing investors that when these things were 2-3% bond yields, they couldn't make the returns for their investors. And so those guys are coming back into the market, and unfortunately at the moment not filling the hole of the Fed and banks that have exited, but there's still liquidity in the space. Mortgages are still getting done. They're just having to clear at a higher price. And it literally is a supply and demand building exercise where you've sucked some demand out. And so supply has to change in order to equalize. And part of that is increased rates.
Well, we do have you're correct about the liquidity part, but I think it could be offset too by the slowing in the housing market anyway. There's going to be
there's less supply there, right? How many people are refining now? Right?
So
yeah. Refi's down 85% year over year. I think that's what it is. Yeah.
Well, if you're refining, it's because you need cash.
Yeah, you're in a bad spot. Yeah.
Well, not necessarily.
Yeah.
You could.
There's a lot
find
of
another investment
yes, that's true.
Improvements to increase your investment value and that kind of thing. But
that's true.
You're going to be paying more for that. But it's a tough time to be in the mortgage origination business if you're on the conventional side. That's for sure.
Mm-hmm. Yeah.
So I'm sorry I keep asking you to put on your what do you call it, the hat that's made out of tinfoil, or looking at your crystal ball.
Yeah.
So what are you seeing? We'll call it 6 months and then a year down the road, as far as the liquidity.
What are you and Renovo planning for? Kind of what's
how
your
do I talk to our sales force about this?
Yeah.
I coach them that they should coach their clients to hit the bid. If you have a deal, it looks okay, don't try and wait and think rates are coming back down. Take the money now. Depending, most of these guys are in it for long haul wealth creation. If you think, you might be benefiting from a shorter prepay because you want to make that bet, that's fine. Pay a little bit more for that, but take the deal now. I think, again, they've clearly said, the Fed has said that their terminal rate is 5%. There's going to be more increases to the Fed funds, which is going to put pressure on interest rates. Now we've got the supply and demand balance. So does it actually go 1 for 1? I don't know. but I would be willing, I'm taking the bet that rates are going to continue to go up on this product and otherwise in the market, at least for the next, call it 6 months. So I'm counseling our team to have those conversations with their clients and to talk about, how we can be a partner and think through penciling out deals and what are options. But if you have something, you still want to invest, you should hit the bid and take the deal now and not think that, that things are going to get better in 6 months, because they're likely not.
Yeah. I mean, we don't know. I mean, 6 months inventory could be up, inventory could be down, rates could be down. More than likely, they'll be up. So yeah, I mean, I completely echo that. It's, if there's a deal, I mean, like we talk about, Bill, when you bought your first house, it was what, 14% interest or something like that?
14.5% was my FHA rate.
Yeah. So it's like, you can, and a friend of ours, I mean, he bought his first income producing rental home. I think it was like 10 or 11% interest rate. It's like, the deals are always there. If you know how to underwrite them and find the deal, the interest rate, as long as you can make money and it makes sense and it pencils out, pull the trigger, because you don't make any money not pulling the trigger.
Well, and I'll add to that as well. Real estate investors are problem solvers. That's why they get into this business in the first place. You're not going to be successful unless you're a problem solver. You're going to make your money on the buy in the first place. And all real estate investors, professional real estate investors, make their money when they purchase the property in the first place. Yeah. So they're always out there looking for the deal. Part of what will happen eventually is that the sellers in the retail market will finally start catching up with the actual market.
Yeah. Now, Brett, I wanted to ask you this question, because we know, the Fed is out and we're, being filled in with, more or less private capital or outside capital, which is not quite filling the void. Even if we can get to a point where the volume of that can pick up, do you see rates on the DSCR program declining, even if we can get more liquidity into this niche market?
That's a very good question. There, my crystal ball is broken. I actually don't know. I mean, there's so much volatility going on, and you've got two things that are really working not in a perfectly correlated. So one is the liquidity. So yes, Jonathan, on that hand, if you get more liquidity, and it's a similar story to where we were a year ago. Rates are falling because there's more people chasing the same deal. But on the other hand, you've got credit spreads that are widening. And when I talked about historically, call it 1.5 to 2 points higher than where conventional mortgages are. Right now, they've been pushing up. And so there's a risk adjusted return that a lot of investors are looking at, and sometimes they're at odds. And I'll say, you see, again, real estate is very local. Your investors know their markets, and not all markets are created equal. But when there's a headline every day about home prices depreciating and issues in certain markets, tends to push credit spreads wider, because we get painted with the same brush. So I don't exactly know clearly what's going to happen, but I think there's a lot of factors that I like to look at, and that's benchmark rates. That's what does kind of where are deals getting done in the market? What is the credit quality of those deals? Where are we seeing kind of leverage levels tighten up to? And then it's at the end of the day, it comes down to investor appetite, because of all the products in our suite, the DSCR product is so much driven by the market, and it's a relatively transparent market.
Yeah, well said.
Well, I mean, you have people that still could get, as I was talking about, these retail sellers figuring out that the market has dropped. You could also add in a subject to current financing. That doesn't help us in the mortgage business because we're not getting any financing out of it. But at the same time, those can be a little bit difficult because they're only going to fit the right person, because the person selling the home, if you're doing a subject to the existing financing, they can't qualify for another loan because that old loan is still in their name.
Yeah, that's true.
So it's got to be somebody that makes a lot of money and doesn't matter, and they need to go.
No.
And at the same time, they're going to be buying a house that their rate's going to be much higher. So they have to think about that too.
No.
But if you have to sell, you have to sell. And there's deals out there. And that's why I said we're problem solvers.
No.
And it's just a cycle.
That's right. Well, Brett, I know we're running out of time here, but I wanted to give you the floor. Anything that we didn't ask or you think is important or needs to be touched, please let us know, because we appreciate your expertise. You see a lot more than we do and a lot more globally. So anything you have to share is always appreciated.
Sure. Well, I think this is a great conversation. I appreciate you guys having me on the show. The one thing I would reiterate, again, how I'm counseling our team is hit the bid. I don't know any other better way to say it. If the deal is there, the deal makes sense. Don't think it's going to get better. I think the same comes true what we're telling our flipping clients of, if you got an offer in hand, it might not be exactly where you want it to be, but it's an offer. You should think about kind of taking that. So that's what that would be my parting words.
Excellent. That's the word or the phrase of the day would be hit the bid.
Yeah, we talk about that all the time with some of our flipping clients that will step over a dime to pick up a nickel, thinking that they're going to get a better offer, but they end up spending more money because it takes them longer to get it sold.
Yeah. Oh, and I did have one more question. So between and you correct me if I'm wrong here, but I think more or less between May and now, I suppose, we've seen a huge increase in bridge loan and bridge, and borrowers getting bridge loans, more or less to, basically get an interest only rate to see what the market's going to do to buy themselves time. Are you all still seeing an increase on your bridge loan side, or has that slowed down?
Volumes overall have slowed down. So our volumes have come in, and then the mix has changed. So our DSCR volumes have decreased as a share of the mix relative to bridge.
Sure.
But I think what we are seeing is for experienced investors and investors who know their markets, there are deals to be had. And at this point, it's really we're focusing on kind of credit quality and people that we want to work with, and people that understand how to get out of a problem if they were to get in one, and are being very smart and selective. And so I would say some of that volume coming in isn't necessarily because there aren't deals to be had. It's because our investors who were doing 10 flips a year are now saying, I only need to do 5 and I'll be okay. I want to be very selective with how I approach this given over the coming year. So there's also a lot of noise. Inventory levels, we have an aging housing stock. Home builds have been the lowest level since pre-crisis. So we're bullish on the market. I just think now is not the time that we're going to be setting sales records, and that's okay as we work through some of this uncertainty.
Sure.
Exactly. And if that's across the board. Everyone I've talked, inventory and production has slowed down for everyone that we've talked to. It's going to, again, increasing rates, decreasing housing stock. It's tough. You have more people trying to fight for the same product with higher rates to get it. Yeah, of course it's, we're going to see a slowdown.
I hate to say it, but it's a lot like the weather. When it's cold on the West Coast, it's warm on the East Coast. We've had record low rates. We've had record high sales. We've had record high prices. It's got to come back down to earth a little bit. So hopefully the pendulum won't swing way too far, but it's got to get more realistic, and it wasn't sustainable. So I'm kind of happy to see it slow down.
And I think you're also going to see a shakeout in investors and lenders, right? So the guys who are in it was really easy to paper over problems when home prices were riding a rocket ship, right? Now you're going to see the real people who know what they're doing, how to solve problems from both the lending side and the investor side. And I think that will be, in the end, good for the industry, but it might be a little bit painful.
Yeah. You're like, we've already, didn't Sprout close its doors?
Yeah, they did.
Yeah. And there's been several others. There's been mass layoffs across the board from a lot of places. So you get to see who is prepared and ready to weather this storm. And I can, I can tell you we are, and I know Renovo is. They've positioned themselves quite well for this.
Thank you.
Brett, thank you so much for joining us. I really appreciate you throwing some knowledge on our guests.
No problem. Anytime, guys. It was my pleasure.
Awesome.
All right.
Thank
Take care
you.
of yourself. Folks,
Yeah.
thank you so much for joining us on the Real Estate Investor Show. Hard money for real estate investors. We are Carolina Capital Management, private lenders in the Southeast for real estate professionals. If you would like to, if you'd like us to take a look at one of your projects, go to carolinahardmoney.com and click on the Apply Now tab. If you're an accredited investor looking for passive returns, click on the Accredited Investor tab. Don't forget to like, share, subscribe, hit the bell, and don't forget about Wednesdays with Wendy. See you guys next week.
See y'all.